Welcome back. Today we're looking at an analysis report on Richtech Robotics, or RR.
Mm-hmm.
The core idea is that its financial stability, specifically having zero debt and over $85 million in cash, is the key bull case, even with its current losses.
Right.
Let's jump right in with the first point, which focuses on that financial strength. The report calls it a liquidity fortress.
And it really is. I mean, 85.5 million in cash, zero debt. That's a powerful start.
A very powerful start.
But here's the first major point of feedback. The report must immediately quantify the operational runway to transform that liquidity fortress from just a number on a balance sheet into a concrete, measurable competitive advantage.
Okay, so the weakness is that the numbers are there, but they're not connected for the reader. You have the cash figure here, and then the operating loss about $7.1 million somewhere else.
Exactly. You're forcing the person reading the report to do the back-of-the-envelope math themselves. And that's a missed opportunity to land a powerful point right away.
So the suggestion is to bring that calculation front and center.
Right up front. Integrate the cash runway calculation directly into that opening liquidity fortress section. Don't make them hunt for it. Turn that abstract cash figure into a defined multi-year safety net.
That makes sense, but let me challenge that for a second. If you immediately say they have, 12 years of runway at the current burn rate?
Roughly, yeah.
Doesn't that huge number almost undercut the urgency? You want investors to feel excitement for growth, not just, comfort that they can survive for a decade.
That is a fantastic point, and it comes down completely to framing.
Okay.
You're not just listing the time, you're framing the strategic freedom that time buys. So for a concrete example, instead of just listing the cash and the loss separately, the report could state that the $85 million provides the company with, yes, approximately 12 years of runway.
And the key is what that means.
The key is what that means. It means Richtech Robotics doesn't face the same quarterly existential panic as its competitors who are hooked on VC money or servicing debt.
So the 12 years isn't a cushion, it's a weapon.
Precisely. It's a strategic asset. It's the luxury to pursue long-term R&D, to iterate on a complex model like robots as a service, to enter tough markets like healthcare, all without desperate, forced capital raises. That's the real significance.
I like that. It reframes the whole narrative from defensive stability to offensive endurance. That's a much stronger hook.
It is.
Okay, so if we've established the runway and framed it as an offensive tool, we need to talk about the actual offense.
Right.
The report goes into the shift to this robots as a service model, focusing on the Atom robot in places like hospitality and healthcare.
Yes, and this is where my second point comes in. The cash position is the core bull thesis, but we have to look at that price-to-sales ratio. It's over 100.
Extremely high.
It is. So the report needs to draw a much clearer causal link between that balance sheet strength and specific, concrete, competitive maneuvers in the RAS market.
So the weakness is that the analysis kind of says investors are paying for future potential.
Which is true, but it's too vague.
Yeah, but it doesn't really show how their financial health lets them capture that potential in a way others can't.
Exactly. My suggestion is to use that zero debt position and that massive current ratio of over 72 to propose actual operational strategies that a competitor scrambling for financing just couldn't match.
So we're moving from a defensive shield to a strategic weapon. How do we show that weapon in action? What are the concrete examples?
Well, instead of just general optimism, the report could suggest specific aggressive uses of the cash. For example, they're targeting high-visibility venues.
Okay.
One concrete way to leverage the balance sheet is to aggressively subsidize the initial RAS deployments, offer longer, almost risk-free introductory contracts.
So they use the cash to literally buy market presence.
They buy it. They get into national casino chains, major airport lounges, stadiums. A competitor who needs positive cash flow from day one can't afford to lose money on a contract for 2 years. RR can.
Right, they can use their balance sheet to basically purchase that critical brand recognition immediately. It fundamentally changes their customer acquisition cost.
It does. And building on that, think about non-organic growth. With that balance sheet, they can secure better long-term supply agreements for key parts. Or even better for the growth story.
Acquisitions.
Small, strategic acquisitions. They could buy a complementary RAS portfolio in, say, a niche healthcare automation field.
And the key distinction there, and this is what an advanced investor wants to see, is that they can do it without taking on debt or diluting shareholders.
Precisely. You're buying a company that can execute growth painlessly. That's how you justify a PS of over 100, not just by saying future potential.
That's a much more complete and, frankly, a much more compelling picture. It moves the analysis from just describing the situation to prescribing a strategy.
Which is the goal.
Okay, let's turn to the final point then. The structure of the forecast section.
Right.
The report has the fundamental bull case target, $6.30, which is clearly based on a long-term view. But it's sitting right next to really specific chart analysis.
The V-shaped recovery, support, and resistance levels.
Exactly. And that's the core issue here. This analysis is fundamentally a long-term investment rationale, and the structure has to clearly segregate those macro themes from the short-term, micro-level trading signals.
I agree. The weakness is that it blends two different languages.
It does. It confuses the message, doesn't it? You're reading about a multi-year thesis built on balance sheet strength, and then suddenly you're told it must hold support at 386.
It dilutes the primary message. It creates a kind of a conflict in the investment thesis. Are we buying this for 5 years or for next week?
So the suggestion is to refine the structure to cleanly separate them. The long-term valuation argument from the tactical trading stuff.
But you don't want to just get rid of the technical details, right? I mean, that's valuable information for a certain type of investor.
No, you don't get rid of it. You just put it in the right place. The current structure diminishes the intellectual weight of that financial fortress thesis we just talked about.
Okay, so you're suggesting structural clarity to protect the core message.
So what are the concrete steps for that? How do you restructure it?
It's pretty straightforward. For a concrete example, you keep the fundamental price targets, the bull case of 630 and the bear case of 252, in the main forecast section. They relate directed to the long-term valuation.
Okay, that makes sense.
But then you create a dedicated, clearly labeled appendix, or maybe just a subheading. Call it technical trading notes or short-term considerations.
A completely separate box for the tactical data.
That's right. And that's where you put the specific price points, the 410 support, the 550 trigger, the discussion of the V-shape, the high beta.
I see. So this maintains a really clean focus on the main narrative, the financial fortress, the ROS strategy, and treats the technicals as important, but separate, data for a different purpose.
It's an elegant structural fix. It ensures the integrity of the long-term philosophy you've worked hard to establish. It just stops the short-term noise from undermining the multi-year signal.
That makes perfect sense.
You know, the foundation of this analysis, that clear focus on the $85 million in cash and zero debt, is incredibly powerful.